Welcome to PM Express Business Edition. We've seen their first quarter numbers, and some will say it can't be described as interesting. So can we now confidently say that they are out of the woods post this domestic debt exchange program? And are all these commercial banks out there responding to regulatory interventions and directives in these interesting times? Can we say that the outlook is bright and good? Well, I may be going ahead of myself. Maybe I'll get a more detailed answers to these concerns with the Chief Executive of the Ghana Association of Banks, John Wiafe. So, thank you so much for your time. And I know it is quite interesting times. And if we are swayed by the numbers, can we make that judgment that indeed these are good times for the banks based on the Q1 numbers?
Thank you very much for having me. I'd say it's still early days. It's first quarter. We all know from managers of the economy that the recovery is happening, the economic recovery is happening. And as banks, as the economy recovers, of course, we should, as community, be the anchor, to propel that growth. So, yes, the numbers look good. The only unfortunate thing is, whilst the top line is looking good, the risk element is also trending upwards, which is not the good news. Where our non-performing loan ratio is at the moment, I wouldn't say that the industry has turned the corner in terms of the quality of the earnings.
But Mr. Aren't you just being measured with your outlook? Because we had this last year when the numbers came out, and I had an interaction with you. We've seen Q1. There are still strong indications that, we are seeing growth in the loan book. We are seeing growth in the revenue as well, interest incomes and all the rest. And therefore, for the layman, we'll look at these numbers and say that they are out of the woods.
Yeah, the good thing from where we sit, the good thing we take from the numbers is the fact that, the regulator, even in the MPC report, talked about capital shortfalls in some of the banks, and it is important that the earnings of the banks, catch up, so we can more or less accumulate some capital to beef up the buffers that as an industry we require, or as community of banks we need to operate safely. I'll repeat what I said, that the quality of the earnings, that's where we look. And the quality is judged by the quality of the book, and which is also driven, the outcome of which will be on your impairment line. And if you saw the impairment, it's not a healthy number to be proud of. And it is interest income, interest expense, your commission and fees, operating expense, and your impairment line. And if you see that line trending in the direction that it is moving, it's not something that, as an industry, we are happy about. And of course, some of the indicators that worry banks, they lag. They call them lagging indicators. They don't go ahead of the numbers. So you can be making some good revenue now, and if the quality of those revenues are not that solid because of heightened impairments, then of course, and that is driven, obviously from the numbers on the top line and the fact that interest rate is where it is now, which means that the likelihood of default will be high, probability of default to be high, and that it has a way of transmitting into your impairment numbers.
So, what are we not doing right, or what are we doing wrong that the non-performing loans, or these loans that the banks fear would not be paid back on time, is still a major challenge? Because we thought that we could be getting over this, but it appears for you it is a big challenge now.
Yeah, it's a multiplicity of factors. There are several factors that work against the banks when it comes to recovery of distressed assets. Our legal system or the judicial system doesn't help with recovery. If you took a bad loan or a customer who has a bad account or a bad loan to the courts, the way the court system can play the bank, seeing the bank as though we are vultures trying to kill the borrowers. Meanwhile, the people have defaulted, and the bank is just taking steps to recover, and you find that you'll be tossing them from court 1 to court 2, court 3. By the time you enter execution, the underlying asset that will help you to recover is almost gone. Land administration is another problem. Of course, the environment also doesn't help, given where interest rates are. If you borrow right now at 35% or let's say 30%, what kind of business are you going to do to be able to return sufficient profit to pay off your finance costs? It's a very difficult environment that the banks operate in. Yes, the credit risk environment within the banks, needs some fine-tuning as well. I know that banks have taken steps to, ensure that the rigor around loan sanctioning is also improved. But generally, the credit culture in the country is very bad. It's terrible. I mean, I'm sure you have examples where even friends and family members have come to you for sometimes as little as 1,000 cedis and you have become the enemy, though you are the one who lent the support. It's the same people who come to the bank. The same people who, we give 500, 2,000 here, even Momo. You say, don't transfer to my Momo account because I've borrowed. They don't want to pay. That same culture is what, the same people are the people who come to the banks to borrow. So that tendency that, I can just default and there will be no proper consequences because I can hide under the cover of the courts and the lawyers playing the banks, it doesn't help.
But Mr. White,
one thing that contributes to the bad credit culture is that there's no proper consequence. People can default in rent payment and they still have access to the banks because the bank has no visibility on the credit profile of the borrower. We don't have 100% visibility. It is possible that sitting here, you may have taken some supplier credit. Maybe you have some mom and pop shop somewhere. It should all go into your credit scoring. But we only see what we have given to the Credit Reference Bureau. Unfortunately, it's not sufficient because there are other credit points that have not been consolidated. People know this. They know that I can borrow from friends and family and still go to the bank and take money. The bank, we use what we call the debt service ratio, DSR. George Wiafe, you earn 1,000 cedis. No bank will give you 800 facility that will result in you paying maybe 800 Ghana cedis when your earning is 1,000 because the debt service ratio will be too high, and which means that the probability of default will be high, and you will be left with just little disposable income for other expenditures. So we carefully set this debt service ratio at a level that leaves room. Unfortunately, that room is consumed by other lines that the bank has no visibility over, which are also credit lines. It can be rent, it can be borrowing from friends and family, it can be any other, kind of credit activity that also takes away from the borrower, which reduces their ability to service the actual loan they came for from the bank.
So what would you tell those who would also may argue that your bank's drive to grow their loan book, meet targets, could be a contributing factor that they don't do the required due diligence on these prospective borrowers, and that is why it's often falling these high NPLs?
No, I mean we get asked these questions every now and then. I can tell you that the rigor that goes on the credits, yes, performance
credit
pressure,
committee has a huge target to meet Q1.
Performance pressures are there. Whilst the originator, the loan originator, maybe the coverage person or the relationship manager has loan targets, there is somebody whose business in the bank is not loan target. His is to make sure that the credit you are sanctioning doesn't result in impairment. They're called the risk people. They are independent from the origination. So you will bring the deal, but you're not the one going to analyze the deal. So yes, your performance pressure may potentially cause you to bring some loans that may not necessarily be good ones. There is a check, and that person is called the chief risk officer. His job is to look at the loan. He doesn't know the customer. All he's doing is this facility, does it have sufficient cash flows to pay off or to liquidate? Is it the right product? They do all this kind of assessment. I can tell you, I said one of these days I will invite you to sit in one of the credit committees of the banks, and then you will see the kind of rigor that goes into the decision making. The environment is not right. I use the 2008 financial crisis every time as an example. In America, overnight, thousands of houses were put on foreclosure. They didn't have to go to any court to go and seek any orders. You have defaulted, you can't pay. Immediately,
the legal system is not helping you.
It helps. What it does is that people know if we default, the bank will come after me. And when they come after me, they will win. And when they win, they will get more liquidity to give loans to the next person. You know, so when the court system makes it difficult for banks to recover properly, what it does is it inhibits the banks from sanctioning the next credit. It increases unnecessarily the cost of lending, because then the bank will factor in this potential default into the price.
Is that what is happening now?
Of course, it will happen.
This is what is happening now in the country, actually.
I mean, so long as banks struggle to recover bad assets, and non-performing loans is where it is. I think it's about 24%. For every 100 cedis that banks give away as loans, they are likely going to lose 24 cedis. It's scary. If you give your deposit to the bank 100 cedis, and you come to the bank, you want your 100 cedis back. The bank cannot say, oh, when I gave your 100 cedis to Mr. B, he could not pay all. You only pay 66 cedis. So I have only 66 cedis against you. We can't do that. So it increases the cost of funding for the banks.
Does it justify the sudden reduction in the loan disbursement as we've seen in the MPC, that the loan books or the growth in loans to private sector has dropped significantly?
I believe it's a factor of the economic circumstance of the country. I'm not sure if you are the business. I'm sure the business people are also, should I say, reasonable business people, and they look at the credits, the cost of credit, and they juxtapose that against the potential earnings from the borrowing activity. And if you're not going to generate enough to pay 30% in interest, why would you come for the loan? So it is a demand and supply issue. Take two to tango. It's not the bank that must be chasing the customer every time.
Is the slowdown in the lending thing a bit that is coming from the commercial banks, or rather the individuals who are not coming to the banks to take loan? I believe that it's coming from the commercial banks who are not lending, and it's not people who are not coming to banks.
It takes
because when I engage the businesses out there, they complain that we are struggling. I have a good record, I have a good credit score, but I'm still struggling to convince these banks to lend to me.
That struggle includes the cost of the funding. It's not like the funding is not available. They can't afford the cost. And the cost is driven by the economic circumstance of the country. The variables that derive the lending rate is there. It's independently verifiable. You can check, and you realize that.
So then it's coming from you. It is not coming from the businesses.
No, but the banks don't
want to lend.
the banks don't create inflation and the other interest rate and the currency depreciation. We don't create it. You understand? So we are in this country together. You understand? We just about 2 years ago, lending rate was average 19.5%.
Now what is the average? About 30?
It's about 30%. You understand?
So it is the same bankers,
but the point is
the normal clients.
It is the same bankers who were lending at 19% who are now lending at 30%. They have not changed. What has changed is the economic situation in the country. So if the situation changes, you can trend. You pick the data. You are a business person, so you pick the data and plot it. Where policy rate is, interbank rate, treasury bill rate, and just oppose that against the lending rate. And you find that they all move in the same direction. They move in the same direction. And in some instances, the slope of the lending rate is more aggressive than the slope of the other three rates that determines the Ghana reference.
So if I get from you the slowdown in lending, or the banks are not lending because of the high NPLs, and then the current environment, and that is what
I believe so. I don't have
these are some of the major reasons.
They are the key. I'm sure to be the key reason. Businesses are, they'll consider and say, I'm coming for 10 million, interest of 30%. It's a lot of interest cost. What am I going to deploy this 10 million to? Particularly if it is for a project that can take quite a while to begin generating cash flows. By the time you finish, you have paid another principal in 3 years. You understand? In interest. And you need to look at this. So it takes two to tango when it comes to lending. The business community and the individuals, economic actors will make a demand. The banks assess the demand, and then they will approve. The banks, in also assessing, of course, we also look at the economic circumstance and see This customer who says he can pay 30%, is he in the right business? Is that market growing? What is the share of the market? Is it generating sufficient cash? Is that cash sufficient to pay the loan and also keep the business in business? So it's a whole lot. The businessman is analyzing, the bank is also analyzing.
When do you see the situation improving in terms of the loan book or the credit extension picking up? Because there are a lot of genuine businesses out there that are crying that we need credit to do business.
I'm sure, and I like the messaging that is coming from the finance ministry, it's coming from the World Bank, it's coming from the IMF, from Bank of Ghana, all pointing to the fact that the economy is recovering. As the economy recovers and the variables, particularly inflationary pressures, inflation comes down in the manner that the central bank has projected, then we will see the other rates trending down. Lower pressures on the currency, which also fuels inflation. If that also comes down, you will find that if a policy rate is around 20% or even below, and the other one, interbank and the treasury bill rate moves in similar fashion, of course, lending rate is not. We are not far from coming to where we. If I analyze, not too long ago, before the DDP, 19.5%.
If I analyze all these major factors, then I see somewhere next year possibly, because the projection by the world, the Bank of Ghana is that ending the year around 13 lower band, 17 higher band. The IMF is saying that growth is going to pick up strongly going forward end of the year. Inflation is slowing down further. CD with the projections, things might stabilize firmly a little bit. It looks like next year maybe.
I'm sure this year, I'm sure sometime from second half going, we'll begin seeing these reflecting in the numbers. These are sentiments and projections. Once we begin seeing the reflection in the actual numbers, these variables have a funny way of behaving. Once the sensitivity begins in the right direction, moving slow, coming down, you will find that, like on the currency side, the speculative element of the currency depreciation begins waning, and then you find that it comes down even more aggressively. So coming down, policy rate was maintained at the last MPC meeting. I'm hopeful that, or we are all hopeful that as inflationary pressures begin coming down, again, like we saw in the early part of the year, Bank of Ghana projection, a low of 13, high of 17, which is perhaps an average of maybe somewhere 15. Once we begin moving in that direction, of course, to reflect in the rates, and then lending becomes more affordable, banks become more open to businesses. Businesses will see that they can afford the lending. Then you find the lending rate coming down in tandem.
So in the third quarter, if George Wiafe and co should come to your end, and they have a good credit history, the cash flows have picked up strongly over the next 3, 4 months, 6 months, would I get a loan from Mr. World Bank?
It's not like banks are not lending now. Banks are lending, except that the borrowers are careful. You understand? It's not like banks.
But the BOG data shows a contrary view in terms of credit extension.
That's what I'm saying. It is the demand.
Yeah.
You understand? Because people are assessing this loan I'm going for, can I pay back? You understand? So once the variables move in the direction that you have just described, and it becomes more affordable to the business community, to individuals and households, of course, banks are there. That is the business of banking, is to lend. Take deposits and then lend. That is your business. And no bank, we just had a meeting last week, no bank has said we have put a stop on the tap and that we are not lending anymore. No bank has said that.
Because some will say that if you look at the BOG instruments that you're buying, the T-bills, they are getting a lot of money. If you go through your financials, you look at the impact of BOG bonds and that most banks purchase that has impacted on the bottom line. Maybe that is more favorable than lending to common men side of Bosokai.
No, but if the environment is such that the demand side of the borrowing activity is slow, what do you do with the deposits that you have? It must find a home. So it's not like banks have changed their strategy all of a sudden to say we are investing. In fact, there are a lot of banks who now have sovereign limits. They just cannot go above it. So yes, you find that in total perhaps it's gone up, but it's because we cannot just take deposits and put them in the vault doing nothing. It must find a home.
This is PM Express Business Edition as I engage the Chief Executive of the Association of Banks to look at development in the banking industry, and also when it comes to this debt exchange program of the banks now fully recovered, looking at the very interesting numbers that they posted for the first quarter of this year. We'll take a short break and we will be right back. Welcome back to PM Express Business Edition. As you engage the Chief Executive of the Ghana Association of Banks, engage some development in the industry. Look at whether finally we can say that they are out of the woods, or he wants to be more cautiously optimistic about the outlook for the banking sector. Let's come to some development in the industry. And the Bank of Ghana wanted you to lend, since you're talking about lending, and try to review some requirements and all the rest. First, let me get your thought on the policy rate being kept unchanged. I mean, at 29%. Some excitement to you?
Yeah, one would have wished that maybe it should have come down, but I'm sure in the central bank's assessment of the inflationary pressures, it's still more or less, though it's subdued, there's still some heightened pressures, and for which reason they kept the policy rate at where it was at 29, has been kept at that level. So should I say it's a relief? It's we are all for lending rate coming down, and given that 40% of the weight is on the policy rate, it means that any significant reduction has a way of transmitting into the lending rate to make cost of lending more affordable.
And what could be the impact on, again, I get from you that on the cost of lending going forward in the next month or something, for those who are servicing existing loans, those who want to make that wild gamble of coming to you for credit.
It shouldn't be a gamble. Yeah. It should be a proper decision.
Yeah, from their side, because everything on their side is okay. They still want to test the waters. Let me use that expression rather.
Again, the banks have not stopped lending.
Okay.
The banks have not.
Okay.
The banks are lending. Information we have is that demand is low because, of course, there are a lot of factors that borrowers are considering before putting in their requirement for loans. We are all hoping that the rates come down more aggressively than it is doing now. And of course, it's not like a curtain that you go and raise it up or down. It's a derivative, it's an interplay of three different rates: the policy rate, interbank rate, and then the treasury bill rate, together coming to determine the Ghana reference rate. So to the extent that the central bank predicts significant drop in inflation, which of course the policy rate is normally used, one key element of its use is to try to arrest inflationary pressures. So if that risk to inflation comes down, or inflation going up comes down, that risk comes down, of course it will reflect in the policy rate, which then feeds into the Ghana reference rate, and of course into the lending rate. So we are all hoping that the variables, as we have said, move in the right direction, given that from all the people who have access to substantial volumes of data, World Bank, IMF, the Ministry of Finance, Bank of Ghana, even from our own research team here, they are all predicting that rates are going to fall. And if rates are going to drop, then of course lending rate is one of the rates that will be coming down.
The Bank of Ghana tried to take a measure to correct this lending situation. I knew that there had been back and forth engagement behind the scenes when it comes to the cash reserve ratio and how it's going to impact on your liquidity and impact on your ability to lend. What is the way forward in terms of the concerns that came up on the cash reserve ratio for the commercial banks?
It's a big concern for the industry. Now, cash reserve requirement can go as high as 25%. And depending on what percentage of your balance sheet is in foreign currency, you know that your reserve for foreign currency in cedis as well. So for the banks that have about 35 to 40% of your balance sheet in foreign currency, then your cash reserve requirement can be as high as 35%. What it means is then the liquidity that is available to the banks for lending activities and for other financial intermediation is is limited. You take deposits of 100 Ghana cedis, and you only have access to 75 Ghana cedis of the 100. Of course, it will affect your ability to properly intermediate in the financial system.
And that could have an impact on lending, because the Bank of Ghana thought that if you are not lending and you're holding the money, and some banks get into purchasing of FX and all the rest and holding on, maybe they should take the money from you guys.
It's a chicken and egg. If you want me to lend to, why do you restrict how much money I have to lend? You know, by increasing the cash reserve requirement, then my liquidity levels drop. What do we use to lend? It's liquidity. So it's a catch-20. You know, I don't know whether it's the chicken or the egg which should come first.
I knew that there were some intensive industry engagement from the association side and then the regulator side. Have you made any progress on this, or the regulator still believes that that is the way to go?
Yeah, we've made all the case that we can under the sun. Of course, the central bank use cash reserve requirement not just for protective mechanism, but also to manage inflation. Because the more liquidity they can suck from the financial system, you know, the less that is chasing goods and services in the market, which means that the demand pool or demand push inflation will subdue. So they are using it as a deposit mobilization, or taking deposit out of the banking system as one of the tools to fight inflation. But there is a consequence of it also increasing potentially the cost of lending, which is something we want to bring down. If our cash reserve goes up and banks know that they've taken deposits, which means the effective cost of their deposit is now higher, it will reflect in the cost of lending.
And that is what is happening right now, some would say? Yes,
of course, yes. If you take money from the pension funds, it is treasury bill plus 1 or 2. And that takes you to about 27%. If that 27%, I take 10 million and I'm only going to have 75% of it, you know, as my available funds for intermediation, then it's no longer 27%. The cost of that 10 million is now in the region of 32% or more, depending on the effective cost, how it is calculated. You know, so we may be fighting one battle and losing the battle on the other end. We may be fighting inflation here, but the cost of lending is also going up. When cost of lending goes up because the cash reserve requirement is significantly high, it also increases the probability of default, which also would then increase our non-performing loan ratio. So it's, we don't win anywhere, you know, and our view is that we are hoping that as soon as the inflationary pressures come down, the central bank will reassess and perhaps reduce the cash reserve requirement once again as it did last year.
But and you talk about the cost of this regulatory measure. Already some banks have given, one bank tried, it was recalled. Some banks have given an indication that on the FX bet, they are going to pass on the cost to consumers.
You know, we don't run the strategies of the banks.
No, not in, but I'm just saying that I'm looking at the direction or the pulse or the reaction of the association or some of the banks that if this thing should go forward. One bank tried that, they recalled that action. Another bank has announced as well. It comes with the cost.
I'm sure banks will respond as appropriate. You know, their own assessment of the cost of the increase and the impact their FX deposit is having on their balance sheet and also their performance generally. And banks, you know, they have the right to respond to regulatory measures. So we leave that decision to the banks.
Isn't that counterproductive? Because in one breath, you want to deal with the cost element of mopping up and people keeping the monies with the commercial banks. You don't want a situation where people will end up taking that money or those monies out of the banking system,
of course, yes,
and keeping it under their pillows.
That's what I said. I mean, no bank wants to lose their deposit, so they will evaluate and take the decision that works for each bank and its own circumstance, and I'm sure they will react in the best possible way for the bank and for their customers. We cannot legislate that. We cannot tell banks don't pass on cost. What we can say is banks will do the assessment. Of course, it's a competitive environment, and if the cost to your customer is a certain level, traffic may move from your bank to the next bank that perhaps has not taken any kind of action. But as to banks responding, I think they have the liberty to do so.
I know as industry players, it could be of a concern to you because of the impact on cash reserve and some of these measures as well. The numbers are out. The Bank of Ghana has come out to give some assurance in terms of policy solvency and all the rest. As an association, are you convinced by the assurance the regulator is giving that despite their lost position, they are still in a strong position to conduct their monetary operation as a central bank?
Yeah, I mean, the central banks see more data than we do. So we believe in their judgment calls and some of the policy statements that they make. And yes, of course, we don't have any reason not to believe that.
Because the concern is that this could lead to more harsher policy interventions to try and aggressively improve their position, and that could have an impact on you, the commercial banks, I would say.
I mean, the point is, I'm sure the central bank coming out with regulatory policies, you know, and monetary policies to help in arresting certain imbalances in the economy. Yeah. They also assess the potential impact on the financial system, because the central bank will not take delight in introducing policies that result in cost of lending going over the roof, or limiting banks' ability to do a lot more intermediation, or making credit costs so high that people cannot borrow. Then the monetary policy intervention may not result in the right outcomes. So the balance is a balancing act. They balance these policy measures against its potential impact on the financial system, and we trust them to do the right thing every time, and we just trust that these kind of policy interventions have considered all the other factors within the ecosystem before coming out into implementation. Because
some will say the Bank of Ghana in our financial textbooks and our banking textbook told us that it's the bank of last resort, and if they have made a loss or they are making losses, any commercial bank will worry that would they be in a strong position to lend to me when I make that call?
Loss and liquidity are completely two different things. Yeah. So that does not restrict their ability to intervene in the monetary through their open market operations and other tools that are available to them. I remember when the central bank recorded that significant loss. One of the statements or comments that I heard from the bank was that I think one of the key developed country, one of the central banks posted significant losses. Yeah. There is cost to regulatory intervention. If you are arresting inflation, you are deploying OMO, you pay interest. Yeah. And
that interest went to some of the commercial banks.
To make the OMO attractive for the market participants to participate. So, you find that treasury bills are that when the OMO comes, is somewhere slightly higher, so that traffic can move there for them to mop up liquidity from the system to reduce inflationary pressures. There is cost to that.
Some will say that for the commercial banks also, maybe you demanded quite a lot, and that also has impacted on the Bank of Ghana's books as well, in terms of the OMO and then the papers,
key mandate,
and so they are trying to mop up, and the commercial bank, it comes at a price. Pay me this amount to
monetary stability, price stability, make sure they balance properly. So what the central bank does is not the banks that tells the central bank what to do.
To price it at this level to convince you to buy those papers?
No, they've done their assessment. I mean, by the time the central bank comes with an OMO, they've done the evaluation. They know the liquidity in the system. They know how much of that liquidity they want to mop up. And they know what rate to price in order to mop up those liquidity. So It's not the banks that put pressure on the central bank to intervene in the market. It's the central bank through their evaluation, money supply. They manage money supply, and they understand exactly how much of the money is in the financial system or in the economy that they want to mop back into the central bank's vault. And they have
over 8 billion in Omo. That is quite high.
It depends on what problem that Omo is being solved. Is Omo is being used to solve? If that problem is big, then you need more. So you don't. I'm not sure the research team in Bank of Ghana just comes out and says this week let's issue 10 billion. No, it is driven by the assessment of the system, assessment of liquidity levels, assessment of inflationary pressures, and say how much of this liquidity do we want to mop up. If that means it's 30 billion, it's 30 billion, and they will have to.
And are you convinced by the outlook that these are the actions that are being taken to improve their position going forward? Yes,
I mean the outlook is not just from one source, from multiple sources. From macro perspective, from multiple sources, the outlook has been assessed as good.
Let's come to the Ghana cedi, and there have been a lot of measures. But let me first get the understanding from the commercial banks. What has caused that sudden spike? We know the perennial pressures, but that sudden spike in the cedi's value over the last month. What is the problem from the perspective of an independent Ghana National Bank?
How independent are we?
No, I mean there be a lot of reasons being put out.
It's a concern for all of us. When your currency is always depreciating against the major currencies, it's a concern. I think from two key sources. The first one is the dollar strengthening. So it's not just that the Ghana cedi is weak, but the dollar has also strengthened. And if the dollar strengthens, even the big economies also suffer. When there's a movement out to the dollar assets. So that is one side. The other side is our dependence on imports and the impact that has on the on our currency. Again, we like DFI or FDIs. We want foreigners to invest in our country. When foreigners invest in your country, one thing they do is to repatriate their profits. And when it gets to the season where there's profit repatriation, as we say, perennial, every time after the first quarter, we begin seeing spike in the depreciation because multinationals begin, remitting or repatriating their dividends, and that also has an impact on the currency. So it's been several, factors hitting the currency at the same time. And again, when inflation is where it is, there are people who speculate on the currency.
Hedge against inflation.
To hedge against inflation and as a store of value. Because if I keep my money in the local asset or cedis, in another 2 months I lose a certain percentage of it. So why don't I, create my value in dollar assets? And significantly that can also play to the disadvantage of our local currency.
How has the fear and people who even have demand in December, through the banks, bringing it forward, and all those things also brought some pressure on the local currency?
Yeah, we see this every time there is depreciation. The first month or first few weeks of depreciation is I call it a danger zone. If it is not arrested within the first few days or weeks, then you find speculation coming in. And from my own work that research team have done here, we estimate the speculation aspect of the currency depreciation to be almost about 30%.
Wow, that is interesting.
Yes, it's possible because there are people who are defaulting to dollar because of hedge against currency depreciation, and it's a winding situation where because you are hedging your position, you put more pressure on the local currency, which then causes you to even do more. So speculation is dangerous, particularly if the currency is moving in one direction and people are speculating. It means that direction of movement will experience significant movement, and it doesn't help. We call on people because the central bank has said they have the resources to manage the currency's position. So we need those who do not have need for FX now or dollar now, not to go for dollar because they anticipate that currency is going to significantly depreciate again. You know, because when you are exerting too much pressure, it's like more or less a broken record. You know, you set your own target and you break it yourself. But we need to have some confidence in our local currency and not put too much pressure on it by demanding dollars when we don't have need for the dollars now. Particularly people like you and I, who as soon as we are paid, a certain percentage of the payment quickly going to buy dollar to hedge against currency depreciation. I think we exert too much pressure on the currency by that practice, and it doesn't work well for all of us and the economy as a whole.
But Mr. What would you tell those who also argue that for that rational person, that might be the wise thing to do in quotes? So the challenge here is those who are managing the monetary space to try and stabilize the system to bring confidence to the local currency. If the city is strong, inflation is down, no rational person will want to hedge
people
in the FX.
And the central, what does people should take you from when the central bank speaks? People should really listen, because we've seen it before. Somewhere 2023, early part 2023, currency went all 2022 actually. It went all the way to 16 or thereabout. What did we see? It came down all the way to 11, to 10. So those who are speculating on further depreciation should be very careful. They can bend their fingers big time, because the central bank has said that they have the resources to manage the currency movement, which means they can aggressively intervene and rates can tumble and people will lose money. So those who are speculating should just be careful not to put too much hope in currency depreciating, but that if the central bank intervenes in the manner that they have said they will, they can have the reverse hitting them big time.
So we're helping with some education bit, and that came from your research, which I thought was very, very interesting. This 30%, but is it that the speculatory activities is contributing to about 30% of demand for dollars in these times,
yes,
or what?
Yes, that's what we believe is happening. And also the demand, you know, now we are very, very, very strictly regulated. There are things we cannot do. Unfortunately, there is a parallel black market where the things we cannot do, they are able to
Guta said that they are going to the black market for their FX demand. They are not coming to the banks. Most of them, they pay monies to, and he was confirming that, telling the regulator to come in and try and do something, where a businessman goes to maybe Kojo Dankwa somewhere in Newtown, pays about 500,000 cedis to that person, goes to Dubai and get the FS component.
All those people should be arrested. It's illegal.
They are not coming through the banking system.
Yeah, but we need to find a way of fishing them out and getting them arrested. A central bank has done that before. They've done that before, where they put, you know, mystery shoppers on the streets trying to buy dollar, and once you are not licensed to be dealing in currency and you are dealing in currency, of course, we have to arrest people. People must pay price.
Why is pushing? What is pushing? Because if Guta is complaining about the stringent requirement,
but those are
too stringent that they find it more easier to walk to that man in Newtown, give him about 500,000 Ghana cedis, go to Dubai and get the FS component. Those monies, huge monies, are not coming through the banking system.
Yeah, but the banks have not on their own restricted FX flows. You know, there's something called Foreign Exchange Act. We have to comply with it. So if there are requirements in the act that makes it difficult for the business community, it's a discussion we can have. The central bank, the central bank, you know, working with us, we constituted a small team. We even spoke to Guta. We spoke to AGI. We've constituted a small team, and it's even in the MPC report. The governors mentioned it, that there's a committee that is working on how do we assess the necessary documentation, the documents that may not be overly difficult to have access to by the business community, to enable them undertake their importation legally. You understand? So we've done that work. The draft of our report has been submitted to the central bank, I think last Friday. We are just hoping that the central bank will review and, you know, pronounce, you know, which of the measures that we have proposed they will approve or maybe improve on our requirements, the things that we have asked for. So there is work ongoing, and that is why I have cautioned those speculating on the currency to stop, because they can get hurt. You know, the
what
currency,
is the war picking up? That you're sensing
when the central bank speaks, people should listen.
But you may have a more privileged position in terms of what you're seeing about when the Bank of Ghana could move in to meet all the requirement needs on the market that could track literally.
That would be an insider
insider trading.
If it's a
no, because it looks like this is about the third time you are emphasizing on this.
Then I'll be a billionaire if I'm able to predict the movement of the central bank.
But from your comment, it looks like it's grounded
because it's happened not too distant back.
And that could be the only reason for this caution that
I'm just cautioning people who don't have need for dollar not to go for dollar, because they can get hit.
How bad would they be hurt?
Currency moved from 15.5, 15.5 to 16 to 10 in this country not too long ago. So if somebody bought at 16 and it came down to 10, you can assess the loss yourself.
Bank of Ghana says that as part of these measures, they've taken over your FX requirements and all those things and the things that you need and all the rest, so that they can quickly also step in to meet these demands and all the rest as well. Is it a good thing for you coming from the commercial banks? There were these huge FX demands. We
need to come to the place where we work on our supply sources. I'm not sure. I think there were some articles in the papers, and the central bank even has responded to that about more controls around our export earnings. The things that we don't really need to import. We need some. I don't know whether it comes through policy or it comes. We need to begin stopping certain kind of imports, so that the little dollars that we have are used on essential imports. You know, and also the ease with which people can get currency in this country. I mean, it's amazing. You know, you go to other countries where the depreciation has been managed in a manner, you find that getting dollar is like
South Africa.
It's difficult. I mean, like you pay commission for exchanging your currency. You pay commission. Here it's free. People walk to Forest Bureau and they can change whatever they want. People walk to the bank and they can withdraw $10,000 over the counter. $10,000. In the United States, if you go withdrawing $10,000 over the counter, they will look at you many times.
Some restrictions.
You understand? So we need to come to the point where some controls. We have some controls around dollarization of the country in a manner that places more emphasis on the local city as medium of exchange. As it is now, there are people here whose medium of exchange perhaps is dollar. Dollar school, dollar rent, dollar everything. And we need to get to the level where those things, I know attempts have been done in the past, and they've been reversed. I don't know why, but they've been reversed. But we need to get to the point where other countries have gotten to, where currency emphasis is on the local currency.
So as you try and wrap up on this discussion, I'll be coming back quickly to get your thought. I knew that in the past you made some huge lending to those who are in the oil marketing space and the bulk distributors and all the rest. And what attempt has the bank or the banks making to recover these monies and all the rest and going forward and all those? This is PM Express Business Edition. Take a short break and we'll be right back. Welcome back to PM Express Business Edition as we talk about the banking industry and whether they have fully recovered or the challenges are there. So well, I knew that the banks were very heavy and exposed to these BDCs and these oil marketing companies when it comes to lending. What is the situation now in recovering some of these monies?
You know, through the ESLA, you know, when we had the challenge in 2015, 2016, those legacy debts are largely settled. You know, there are a few lingering, some in the court, through recovery, as I said, 2015, and banks are still in court chasing legacy exposures that were established somewhere 2015, 2017. It tells you the constraints that the banks go through in recovering. The BDCs have also found some other mechanisms for doing their business. You can go through open accounts with the supplier, where you build trust within the relationship. You still come through the bank though, and then the supplier gives you product. You sell the product, then you remit proceeds to the supplier. Banks have also been supporting with LCs, like we do. Some are documentary collections. We've been doing that on behalf of the suppliers. So there are various funding mechanisms. But yes, the number of BDCs have come down. It's not like the wholesale platform like it used to be in the past. And there are some very good BDCs around that are doing good business, and the banks are happy to support any business that emphasize their operations on payment of their debt. If that when you borrow, your number one item on your expenditure should be your finance cost to take care of the exposure, so that others can have access. So banks have been doing it. Of course, the risk still lingers because we do not at present have full visibility on the operations of the BDC. They also have exposures to OMCs. And if the OMC doesn't pay, BDC cannot pay. And it's a whole structure that is difficult for the banking system.
Mr. Wa, are you aware of this company, H-Fields, and they're doing some work with the MPA in terms of recovering all these debts? Are you aware of that?
Yes, we are very much aware. And we think it's a very positive development. Any infrastructure that helps the banking system to have more control on the commodities they finance can only be positive. As it is now, banks pay collateral managers. When they lend to BDCs, products come. The collateral manager goes to the tank farm. The tank farm is not just for one BDC. The BDCs don't have their own tank farms. A few of them, I think one or two of them, have their tank farms. But even that, they rent a lot of space to others. So when the collateral manager goes to the tank farm and he says, "Oh, there's products," whose product is it? Is it the BDC you gave the money to, or somebody else is sharing the tank with that BDC, and therefore the product may possibly not be the product you financed? What H-Fields, from what we understand, when they engage the banks, what they are trying to do is to give the banks visibility on product movement and exposure. So at any point in time, as product is moving from a tank into another storage, that movement is recorded on a system and is approved at the right levels, and the bank has pure visibility, can follow the product from tank to the OMC to cash, back to the BDC, to the bank. You can just follow like that. And that can really help reduce the impairment risk.
Is it de-risking your exposure to these bulk in terms of their working?
If this system works the way it is designed, it will be a game changer for how banks finance the BDCs.
Is this something that the banks themselves cannot do? Some would say that.
It's always good to, if every bank invest in an infrastructure such as that, what is the benefit? And it is not just your exposure, it is the ecosystem. So the fact that the BDC came to you does not mean that you don't have exposure of another bank. So if there is an infrastructure that consolidates and gives pure visibility to all players in the chain, it helps the BDC, it helps the bank, it helps NPA, it helps the OMC. If all actors within this chain are doing legitimate business, then the ecosystem becomes de-risked, and banks can then lend safely to the BDCs.
For you, do you see this as a revenue assurance measure, or it is not a revenue assurance measure?
I don't know what angle would that be a revenue assurance. It is more a de-risking for the bank,
for the commercial banks.
For the commercial banks. We are lending, and it's going to give us more control over the commodity that is providing the collateral for the lending. So I'm not sure how that becomes a revenue. Maybe it becomes repayment assurance, if you want to call it
for the
that way.
Banks,
for the commercial banks, it helps us to guarantee that once we've given money to a BDC and products land in a tank, movement of that product wherever it goes, the bank has visibility. The banks approve at some stages before product is lifted. Not that the third party who goes and dips a stick in the tank and says, "Oh, there's product in there." Meanwhile, that product may not be for the BDC you financed.
So, well, finally, how is the recapitalization process going with the commercial banks? I mean, for those who are based on the targets given by the Bank of Ghana?
Yeah, I think it's going very well. I'm a member of the Ghana Financial Stability Fund, and the IC member, and we've done, quite a number of approvals. Some banks have already received what they asked for.
How many banks have been receiving support?
Also saw reports that the World Bank's 250 million has been approved, which means that the second leg, will begin coming in as as soon as possible. So, yes, there are banks that even after the intervention of the Financial Stability Fund, they may have to do some rights issue for current shareholders to also pump in something or some private placement in some places. In the course of time, the fund or the Ghana Financial Stability Fund will come out with a statement or a press release to give more details about the work that they have done. I'm not allowed to be giving any kind of further details.
They're not mentioning the names of the commercial banks. I mean, in the number, we knew about 2 or 3. What is the current number in terms of those who have received support? Not mentioning any commercial banks.
I'm not sure I can say that, but yes, the banks that came have received. As far as I know, all the banks that applied have received.
So I appreciate your time. So I know there will be another still opportunity to talk about development in the banking industry and whether indeed they have turned the corner or they are still in that runabout of turning that corner. This has been PM Express Business Edition.